I have called the formation of the BRICS and the inevitable reaching somewhere within the next 2 years, because I started 2 years ago with a 3 to 5 year expectation, that when they're all said and done, when they reach whatever their peak may be, what they will have done to world commerce will be equated to what the Industrial Revolution did to world commerce. It is a Bretton Woods 2 in motion. And what we saw now is a much more increase from last year. And what I think people are failing to recognize, that all keep expecting everything to happen at once, they are really doing it through a very organized and manageable and, quite frankly, doable method. And I think, unfortunately, my other concern is that don't worry, be happy crowd that has infiltrated Wall Street for years has paid no heed to this. And I think they're going to be in for an awful shock within a couple of years to realize how formidable the BRICS have come. The one important thing is to keep this in mind, what I tell everybody when BRICS are mentioned. Just think that whatever countries are involved in this and end up trading with each other, they have done so to avoid trading with the United States and also using its currency. How that is a positive compared to when they used to is beyond imaginable. And I don't think it's taken into the equation here when people think about investments. Where they've paid attention, and one of the key reasons why I was such a bull on gold, is what's transpired with gold. This accumulation of gold by central banks across the board was not for an investment standpoint. It was a recognition that a major change is afoot, and eventually gold will play a more important role than it might have played in the last several decades. And therefore, that was another factor. And while they have not yet, and nor did I expect them at this meeting, to announce the specifics of their unit currency and how gold will play a role, they have given us enough of an inkling to suggest it will be part of a role. I think it's been another contributing factor to the great rise in the gold market is what's happening at the BRICS. Well, I think it comes at a time when you can start to question European Union to begin with. Think about Germany. When I started in this business in the dinosaur age of the early 80s, Germany was a true economic powerhouse. It is now struggling to stay afloat. And you can go through much of Europe and see similar situations. At the same time, here in North America, the two former great trading partners, Canada and the US, are both having series of problems on the economic side and also social and political. And therefore, the BRICS have a jump start. They're not up against the formality that we might have been 10 or 20 years ago. But I think the most important thing, that the number one selling point for the BRICS is not only what we did, including with our European partners, to Russia when the Ukraine war broke out, freezing their assets, but then taking the interest that those assets earned and giving it to their enemy really was a calling card to all countries saying, hey, if they did it to us, they can do it to you. And I think that will come back, and historians will look at that as a key factor and all. But all in all, the BRICS are moving in a methodical method. A kind of a friend of mine likes to say drip, 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 boom, drip, 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 boom. And that's how they're working. And I think anybody, especially if you look at the news when the Ukraine-Russia war broke out, how everybody predicted the end of Russia, the crumbling of it, exact opposite has happened for them. I didn't know what a trillion was when I started in the business. Never thought we'd use the word T in investment world, but here we are. The Congressional Budget Office here in America, probably one of the last places that have some bipartisanship left, now has hiked their outlook to 54 trillion US debt before 2034. And by the way, that's without any recessions happening, which would speed up if it occurs. At $50 trillion and a 5% interest rate, we'd have $2.5 trillion in interest expense. The best year we ever had is just under $5 trillion in revenue. So even if that increases a little, we're going to get to the point where paying interest is going to be a serious problem. And the government is clearly not going to be able to provide services, including defense and other things that people have grown accustomed to now. And it's not alone here in the world, as we just pointed out. All this debt has to go somewhere. So I think that's part of the reason also that if you look at many of the key members in this Asian group that's basically dominating, they've been net sellers of U.S. securities and bonds. They're not going long that anymore. There's a debt doomsday out there. The difference now is no longer, well, it's so far out we can not worry about it anymore. Yeah. Most people watching this video will be alive when this debt crisis really hits front and center here in the U.S. One of the most brilliant men that worked on Wall Street is still alive. His name is Stanley Stanley Druckenmiller. In fact, if tomorrow he would be willing to take my money, I would sell all my holdings and just give it him to manage. That's how brilliant I think he is and what an opportunity that would be. And he has now made a huge bet against the bond market. And he has started to recognize, as some others had, that we are getting to a point, especially with the out of control deficits now running multi-trillions of dollars, that we could see a huge spike in interest rates, whether or not there's a strength in the economy because of concerns of our credibility. And we've seen that now. If you think about, we had a 50 basis point cut and rates are higher now than they were before the cut. I think the Fed is pausing now about whatever they might have thought of. Certainly, I don't believe there'll be a cut in November, and there may not even be one in December, particularly if interest rates keep rising. So I think one of the things is the Fed has really lost the ability to manipulate and move markets in the manner that it used to. And part of that is because of much of the dominance of world trade and interest is moving away from the United States, not towards it, as you noted, just on ownership of the dollar. So I don't think it's the power that it once was. Well, my big issue is this, and I think it's an important one. The bottom 50% of wage earners in the U.S., or half the wage earners, almost 50% of them, or 25% of the entire workforce now in the United States, is using credit cards to pay for simple day-to-day needs, whether that be gas, food, clothing, rent, etc. When the masses get to the point where they have to, in a sense, use credit cards, and eventually that runs into an issue because the debt piles up so higher, and that's why we're seeing such a great increase in credit card delinquencies, that upper echelon can't avoid it. Eventually it hits them too. Now, it may not hit them that they're going to be out in the street, but the booming economy that they usually make a lot of money off of is just not going to happen. One of the other issues we have here is we have a retirement and aging crisis. 2/3 of Americans are working paycheck to paycheck right now. They are not able to save for retirement. In fact, all different studies from all different groups have shown that the vast majority of people are not going to be able to retire like those financial commercials show and how you live happily ever after for your last 20 or 25% of your life. The bottom line with that also causes an aging crisis because eventually boomers like me are going to peak and pass. And with that, so will our wealth. And that wealth will move to a younger generation, and politicians go where the wealth is. So sooner or later, those younger people are going to say, listen, you're taxing us to death to pay for this Grandich at 80, 85 years old that wants a big lung transplant. No. So we're going to have an aging crisis and a battle of the ages too, the way things are going. And this is why I just say I don't see most people prepared for it. I like to say that it's better to be a live chicken versus a dead duck, because even if I'm wrong and somehow Nirvana does return, we'll still be in a position to enjoy it. But if I'm half right or fully right, most people are not prepared for it. I do think that the metals market has moved a lot, and a lot of it had to do with the brick. And I expect some consolidation there and even a little corrective phase. It wouldn't hurt. I think there's enough melt up type of momentum still among the Wall Street people, especially once we get into the latter part of November, December. Eventually it's called the Santa Claus rally. But most people pick up a cheer that they might have not had for the rest of the year. And it becomes much more difficult to think about selling stocks. But I do think if your outlook is past the next few weeks and months and you really still invest for the long term, this is a good period of time. So you can go into 2025 in a better frame of mind and hopefully a better framed portfolio. Well, for a person that in 2021 sold stocks just to own gold, I'm quite pleased what's transpired. I mean, this has been a phenomenal rally, maybe even faster and bigger than I thought it would get to. But I do think that it is extended. There are a couple fundamental things that can keep it going, including, a breakout of a war, which seems very, very close in the Middle East and all. But I do think it's deserving of a consolidation period, and all bull markets need to have corrective phases. I don't think it's anywhere near the end. I said when it was well under 2,000 that we can get to 3,000. I said we'll see 3,000 without ever seeing it under 2,000 again. Nothing's changed on that end. I even think silver now, something that was not people angry. I used to say silver was like kissing your sister compared to owning gold, but that's no longer the case. The fundamental argument there has improved dramatically, plus there's a huge short position as well. And so I think they both do well. I would sooner own them still than say general equities, but I think a timeout and a period of consolidation now is good for it. Now, markets don't always do what you think is good for it, but if it happens, I won't be disappointed. There's too much demand. The world has changed. People forget not only how much physical gold bullion has has been purchased, but also how many countries have repatriated their gold from the US and London to own it. This is all happening because they recognize that gold is becoming a more important role in the world monetary system. So I don't think there's a 20, 30, 40% correction in gold, period. I do think it's possible in general equities. And that's what I think another thing that gold has over equities. I don't think it can lose anywhere near as much of what it's gained as the equity market can. I do think it would demonstrate that gold has become a viable part of monetary systems and a system that is clearly where more people are moving towards versus away from our SWIFT and the US dollar. But what people don't talk about in that is if we are correct about that end, what happens to all the dollars that are still out there that those countries aren't using anymore? They come back to the homeland, which becomes very, very inflationary for the United States and a big issue down the road. And it's going to be a very interesting time on the world stage. And like I said, I think when it's all said and done, it's going to have as much of an impact how the world changes economically as the Industrial Revolution did. It's more important now for capital preservation than capital appreciation. Don't spend as much time trying to figure out how you can make $1 into 3, 4, or 5. Spend enough time on how your dollar doesn't turn into 50 cents or a quarter. And I think that's the big change. I think we have to get used to that when it's not going to be as easy as it once was in the general markets. And I just think life around us is going to be that much more challenging. And the real motto of the Grandich household and the Grandich planning group is it's a very simple 3 words. Less is more. We don't need all this stuff. Generally, I can go out and buy a bigger house still. I can go out and buy a bigger car, but it's going to cause more of a financial strain that I'm quite happy in the dwelling I'm at and the car that gets me from point A to point B. The world, unfortunately, because what it sees is being told you're only happy if you get those bigger cars and bigger houses and all. But in real life, that's not the case. Some of the most happiest people you will meet are people with little or no means.